Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Sonu, quick update. So I talked a week ago about dart wars. Remember how my daughter is just taking it more serious than anything in the world. They run around and they shoot darts at each other in public places, and it's just apparently what you do. Well, yesterday, what my daughter does is she gets home a lot of times and she'll just sit in her car and listen to music and do stuff on her phone. So because of dart wars, she now parks in the garage because she doesn't want anyone to shoot her. So she parked in the garage, and my wife gets the alerts on the phone that Susanna's home. And like maybe, who knows, a half hour goes by and she's like, I wonder where Susanna is. I said she's home. And
she's
then
still
Emily
in the garage.
realized she's probably in the garage looking on her phone. And sure enough, she opened the door. She was in the garage with her car on, with the door shut for over 35 minutes, we determined. Now, that is not good. Anyone who knows about a running car in a garage, that could have been a very, very bad day. So fortunately, she was fine. And Emily, made her lay down and do all this stuff. And she called, I don't know who she called. She called somebody, chemicals and something, 911 something. Everything was fine, but it was a good teaching moment for her and my boys that you do not sit in a running car in a garage that's all closed off. So that would have been bad for the old dart wars. So just something you live and learn, I guess, but dodged a bullet in the Detrick family. That would have been a bad day.
I thought you were going to say you got caught in the crossfire or something.
In public, somebody runs up, starts shooting us at a restaurant.
I must say, by the way, I like the outfit. The dress, just for those of you just listening on Spotify or Apple or your favorite podcast and not watching the YouTube video, Ryan is, I don't know.
Even know.
If I'll get this right, Ryan's dressed up like a lumberjack.
Kind of wintry.
With a
this is a new Christmas gift. My vest I'm wearing, and I don't know, the lumberjack napkin looking shirt. I've had that for a while. So I just thought it's kind of cold. It's cold.
I need to get one of those.
I need to dress warm. All right.
Dude, it's like 0 degrees here in Chicago.
You know where it's also cold? Greenland. It's cold in Greenland. So let's go that route.
Hey,
I don't know.
Is it cold? Looks like it's getting hot out there.
All right, episode 171. When do we get tacos? Sonia came up with that. I thought that was pretty good. A lot of stuff to talk about. Let's just start with the elephant in the room, so to speak. The time you and I are doing this on Tuesday morning, stocks are having their worst day in a long time. Lots of concerns that are out there over the U.S. and Greenland and tariffs and all that stuff. I know you've got some thoughts. I've got some thoughts. I'll start, Sonia, then go to you. Just from a big picture point of view, I did a CNBC hit on Friday and talked about some of these things. We've gone over a month now, Sony, without the S&P 500 having a 1% up or down day. Now, that doesn't mean you can't go more. Trust me, these things can go longer. But we've gone a while without much volatility. And then sure enough, over the weekend, all this stuff happened. And who knows where Monday is going to close, but as of now, it's looking like we're going to have a 1% down day. You're right.
Tuesday.
There was the holiday. You are correct. Thank you. And I will say, I do think that wasn't a coincidence. President Trump did this over a 3-day weekend to give markets maybe one more day to kind of calm down, potentially over the back and forth. But let's get into it. What are we thinking about Greenland? Maybe we don't have a strong feeling, but what does it mean for markets and everything else? What are you thinking, Sonu?
By the way, today is exactly 1 year from Inauguration Day.
Yeah.
January 20th. Right? We're recording this January 20th, 2026. It was a year ago. And we're still getting, policy threats, ambitions, all sorts of things, one way and the other. I'll have a blog today on the carsongroup.com/research site talking about, all the policy announcements. Last week, you talked about caps on credit cards and $200 billion mortgage-backed security purchases and a defense bill that
Fed, all that stuff.
The Fed, that's still happening. And then over the weekend, we have a new tariff worry. I mean, one thing I was looking back at my blog pieces that all of us had done over the last year. And one thing that caught my eye was last July, one piece I wrote was the trade war is over. Right? This was back all the way back in July. And that was, the notion behind tacos, right? I mean, funnily enough, it was coined by FT Alphaville, the Financial Times blog back in May from Always Chickens Out. So it's a funny thing. It was like the term of the summer on Wall Street because, markets push back and the administration doesn't look like they can take a lot of pressure from markets, especially the bond market. But anyway, coming into this year, we wrote about this in our 2026 outlook that, one of the headwinds that are fading is tariffs. But I think the president sort of was like, hey, wait, I don't want you guys to forget about tariffs. The White House put out a picture showing him leaning on a table with just a headline, which I love, right? Mr. Tariff. So President Trump threatened to reimpose tariffs on countries that oppose his bid to control Greenland, right? So he's saying, you know what? If these countries don't agree to give me Greenland or give us Greenland, I suppose, right? I don't know. Will it be the 50?
Or will it be like Puerto Rico?
No,
I don't know. I don't know the answer. I don't know.
Yeah. So anyway, he's upset with these countries, Denmark, Norway, Sweden, France, Germany, and the UK. The tariffs, presumably, this would be on top of whatever is agreed on with the deals last summer. The tariffs would start at 10% in February, ramp up to 25% in June. It's all unclear, right? And what happens to the deals then? Do they go away? Or, one thing that's interesting is also, seems like he's still miffed about the fact that he didn't get the Nobel Peace Prize.
So Wall Street Journal had a pretty good article about this because Norway is where the Nobel Peace Prize, that's where the committee is. And he was talking with, I think it was the prime minister, apparently sent a text to President Trump. So apparently they do text. I know it's a dirty word in the world we live in compliance. We don't use that word.
That's
we did not text compliance. Sonu and I did not text. I'm saying the president texted with the prime minister. We'll just leave that right there. And where was I going with this? Sometimes we just make jokes to each other. The Nobel Prize. And President Trump replied, because the prime minister of Norway said, de-escalate with Greenland. And President Trump kind of pushed back, and you can go read the article, but I'm paraphrasing it. And he said, hey, you guys didn't give me the Nobel Peace Prize. I ended 8 wars, You can go read it. You can see it. So clearly that's in the back of his mind as well, with potentially some of this. And he said, hey, if I'm not going to get Nobel Peace Prize for ending wars, then I'm just going to go do what's best for America. I'm not saying it's right. I'm not saying it's wrong. I'm just paraphrasing what the Wall Street Journal had to say there.
And not prioritizing
peace now. So listen, I don't know. No.
I thought the Venezuelan lady gave him the Peace
She did.
Prize.
She got one before, and she gave it to him.
And FIFA, the soccer body gave him a Peace Prize as well, the very first Peace Prize. But there are also the funny memes going around. Anyway, back to tariffs, right? So, and I think any day now, I don't think the decisions come out yet because markets have moved. We're also waiting, by the way, on the Supreme Court to tell us, are they going to invalidate basically, let's say about 60, 70% of the tariffs. Let's say the effective tariff rate right now is about 11%. It was 2.5% before all this got started a year ago. So the increase in tariffs, yes, it's a fairly substantial increase going from 2.5 to about 11% effective tariffs. But remember, that's like the best case scenario. Everyone is talking about before Liberation Day. After Liberation Day, they're like, oh my God, we had 20, 25, 30%, right? We're nowhere close to that. But if the Supreme Court comes out and says that these tariffs are invalid, that effective tariff rate goes from 11% to about 4 or 5%. That's a huge, deal because then companies can apply for refunds. Now, the Supreme Court could say that it's only effective going forward. So no refunds because refunds will be a complete mess. And during the arguments in front of the Supreme Court I think it was November, I think one of the Justice Barrett, Amy Coney Barrett said that, this sounds like a mess. If, she didn't seem to think the administration had the authority to put the tariffs in place, but she was worried about the fact that, if we rule against the tariffs, the refund process is going to be a complete messy situation, right? So anyway, we have that as well. And if the Supreme Court rules against the tariffs, then this whole thing against, this Greenland tariffs thing, that also is like, he can't do that, right? But now he has other authorities, the immediate authority. There's a whole number soup of tariff authorities, and there's something called Section 122 tariffs, which allows the president to basically impose whatever tariffs they want, but the maximum is, I think, 15%, but that's only for 150 days, right? After 150 days, for those tariffs to stay in place, Congress has to get involved, and I think you have some great numbers about how tight the House Republican majority is. It's two seats right now because somebody passed away. Yeah, special election to replace that person in California is not happening till, I think, August or whatever. So I'll just say Congress is not doing anything on this front, right? So here we are talking about tariffs.
Feels like a nightmare. I guess it's a word I'm going to use. We talked about these all the time last year. So we don't have any of the answers on this. Obviously, on Wednesday, is expected President Trump to speak at Davos. You're not going this year, are you? By the way, you're not going to Davos, Sonu?
Yeah, I never get an invite.
I figured.
Somebody should give me an invite.
People are going. That's a lot of people are going. I mean, you've had better macro calls than most of them. You should be there. But anyway, so President Trump will speak at Davos. Maybe he gives a hint at the Fed, the next potential Fed chairperson. Maybe he gives a hint about what's going on with Greenland. We don't know, right? But obviously, markets are kind of taking a sell first, ask questions later mentality. I just looked. S&P down about 1.2%, maybe about an hour or so into trading on Tuesday. Gold up 3%, silver up 7%, palladium, platinum.
Say that again.
Gold up over 3% on Monday. Sorry, not Monday. Tuesday morning.
Amazing.
Silver's up to $94 an ounce. So clearly,
what's a year-to-date return? Right,
like
20%, something crazy. Like I mean, gold's up 7-8. No, probably after this, gold is probably up 10% year to date.
That's the thing
over
we've
the last
talked a
20
lot
days.
about. Makes sense to still own some of these things. If it hits your foot and it hurts, to own some of that in a portfolio. You know, one thing I want to talk about a little more, Sonu, bonds this morning, Tuesday, aren't doing well at all. The Japanese yields have been soaring. JGB yields have been soaring. Really, yields around the globe, honestly, at least on the longer end of the curve are up. So bonds are not giving virtually any protection to equity investors today. It's like you better be in commodities or cash, or you're in trouble. What's your take on the action and yields here, at least Tuesday morning as they soar?
I think Japanese yields set that to the side a little bit. It's been going up for
yes, it has.
Weeks now, if not a few months. I mean, and I think that has to do with the specific situation, macro situation Japan finds itself in. They're getting a little bit of inflation. They want to boost growth, and they have to pick: do we rescue bondholders, or do we keep the economy humming, and do we protect, equity markets, Japanese equity markets, right? Japanese stocks. And I think they can pick only two out of the three. But, we can talk any number of hours on that. I don't want to talk about Japan too much. But U.S. bond yields, the 10-year yield is up to 2.28. We haven't seen that level on the 10-year yield for a long time now. It's been stuck within this. 4.20.
I was going to say it sounded a little low, but
yeah. I was thinking about Japan. In Japan, it's on my mind. Like 4.28 is what the 10-year yield hit this morning. It was up from like 4.20, 4.21. Yeah. So that's a big move for something that's been relatively quiet. Bond volatility has been coming down over the last several months, in addition to equity market fall as well. So I think we're back into that, small version of that dynamic we saw back in early April. After Liberation Day tariffs, equities went down, which is no surprise, obviously, if you have tariffs. So equities don't like it. And I'll talk about why I think the NASDAQ tech stocks are doing worse than even small caps and mid caps and things like that. But remember what happened in April? Bond yields went up. And I think that's what really spooked the administration more than equities. Equities are always volatile. We know that. Bond yields went up. I think that spooked people like Scott Bessent. And he was like, we need to pull back. And if we do get a taco, it'll be because bond yields are going up. Remember, the other side of this, we talked about this, I think, a couple of weeks ago. The administration was like, they want to get mortgage rates down. How do they do that? Buy $200 billion of mortgage-backed securities, or ask Fannie and Freddie to do it. Reduce the spread between mortgage-backed securities and treasury yields. That's one way to get mortgage rates down from, let's say 6.2% to below 6%. But then on the other hand, if your tariff policy is driving 10-year yields higher, that's going to completely negate any benefit you get from compressing spreads. So here we are.
Yep.
I think we'll get a taco. It's just, I don't know whether they'll get it for breakfast, lunch, or dinner.
Well, I don't really want tacos for breakfast. I don't know. I'm sure somebody out there does. Yeah, listen, there's a lot to this, and who knows? Maybe by the time you listen to this very podcast, things are a lot different. But that's true. We went to sleep on April 8th. The S&P 500 closed down 18.9%, came in on April 9th. Market getting obliterated. The 10-year yield was flirting with 5%. Was it James Carville who said, I used to want to come back if I passed away, and if I believe in reincarnation, I came back, I want to come back as, a 400 baseball hitter or something else. He said, now I just want to come back as the bond market because you can intimidate everybody. We used that back in April, using it now. Pretty cool quote. So if the bond market continues to, I'm going to say, spiral out of control, and by that I mean yields go higher globally, that could be what breaks the camel's back with a lot of this geopolitical things with Greenland. But listen, it is what it is. Sonu, you anything else you want to put on that? I mean, we've talked probably long enough. I don't know.
I'll just say the fact that, normally with this tariff thing, I would think small caps will underperform, but small caps actually, remember, over the year to date, we've seen like massive outperformance for small cap stocks over large caps, right? The Russell 2000, looking at my numbers, it's up about 8% before today. This is up until January 16th, whereas the S&P 500 is up 1.4%. So you've got like a 6.5 percentage point difference between the two. That is huge, right? That's the biggest outperformance in a long time. And it's interesting to think why. Now, this is just a hype. I'm just speculating.
That's what we do.
But that's what we do. Right. Yeah, that's what we do. That's our job. I'm just speculating. But I wonder how much of this is really because of the Supreme Court. If the market is front running a potential Supreme Court decision that says these tariffs are invalid, you got to give refunds or no more tariffs, period. Like a big chunk of them. Yes, the administration can put new tariffs, but that's probably going away because, it requires Congress to step in. So I wonder how much of that is, how much of the small cap rally excess performance is being driven by, hey, we think the tariffs are going to go away.
Yeah.
Right. I think it'll be huge if they do, right? Of course, everything, we'll probably see a big market reaction on the day this happens, one way or the other, depending on how the Supreme Court rules. I think betting markets have a 30% probability that the Supreme Court keeps the tariffs in place, which means a 70% probability that they say this is void. This is, you can't do this, right? The other thing, since this fight is with Europe, last year, a big part of the fight was with China. This time it's with Europe. More so than anyone else. And with Europe, I think one way they could potentially retaliate, I don't know that they will, but they could, by saying, you know what, we're going to tax the tech companies more. And I have a feeling that's why the NASDAQ is down today more than small cap stocks.
I'll just say this much.
Fear of retaliation. Maybe.
I'll say this much.
I'm
my friend JC Pretz, he was on with the Compound and Friends on Friday. Great conversation there. He pointed out that, listen, large cap tech, Mag 7, it's been lagging. It's not just like something we've just started to see. It's been lagging for a while now, for several months. So maybe this accelerates that. I did just look. Small caps down like 0.5% time we're doing this. S&P down about 1% the time we're doing this. So once again, small caps are outperforming. Yeah, they're lower, but hey, can't go up every day. But even then, after a full month without a 1% drop, Sonu, and I know we're not at the end of the day yet, down 1.1% on the S&P 500. It can happen for any reason. That's just kind of how this works. Just last week, more than 70% of the stocks on the New York Stock Exchange above their 200-day moving average. We saw various new highs and advanced decline lines on the NYSE, on the S&P 500. Small caps, like we just said, hitting all-time highs. Mid caps hitting all-time highs. Transports hitting all-time highs. There's a lot of market breadth. I mean, large cap tech not doing as well. No, not shocked by that, I guess, especially as I sound like a broken record, but that Time magazine cover, when I see all the AI leaders as the person of the year, and then Jensen, person of the year at Financial Times, the contrarian bell in me said, oh man, that bar is pretty darn high on tech. So to see a little lagging, at least early, not a shock. I mean, listen, tech was lagging a big time into April, right? Remember, DeepSeek happened, I guess it was late February, all that big sell-off, and then you look up by end of the year and tech had come back. So maybe we could be another scenario like that. But the reality...
Do you think that happens? I wanted to ask you that because I saw that thing by a friend JC. I thought it was fantastic. Do you think we get a little bit of a contrarian play? Maybe not immediately. Let's say into February, March, April. Tech comes back again and they're like, here we go. Everyone's talking about the Mag 7 again.
I wouldn't be shocked at that at all. I mean, I sound like a broken record. We're about even weight technology, right? We're probably a tad overweight the money we run for our Carson partners when you add tech adjacent communication services. I'm fine with that. I think when we look up in a year, that those areas are still where the growth is coming from. What did Taiwan Semi on Thursday said? I'm going to paraphrase it. I don't know exactly what they said, but I know they said demand is super strong. I know their CFO and their CEO came out and said, hey, we're not seeing any drops in demand from the people that buy our stuff. Okay, now there's more AI names coming this earnings season, but it is what it is. You know, earnings season, another thing I want to point out, Sonu, Delta, we've used this example before. The K-shaped economy, we get it. What's a K? Some of it goes up, some of it goes down. Some people are doing well, some aren't doing well. You've got some awesome data on this coming up. But I thought Delta summed it up as good as anybody because they said, listen, the front of the cabin's doing fine. The back of the cabin's not. $5.7 billion in revenue in the first quarter business seats. The rest of the plane was $5.62 billion. They made more money. Revenue. They had more revenue on the front of the plane than the back of the plane. They started keeping track of this in 2017. First time we've ever seen that. So listen, there's always examples I can cherry pick and you can cherry pick. We all can do this. But I think that really sums it up, that the front of the plane is doing pretty darn well. You can charge darn near whatever you want, and people are going to pay it to sit in the front of the plane. That's a K-shaped economy to a degree. Do you have any thoughts on that one, Sonu? That one just stood out to me when I saw it.
I mean, it seems like we've come up full circle. I wonder if you'll go back to, the old days when you had like the Concorde, right?
Yeah.
It was all first class, or maybe not even business class. It's all first class. I wonder if you'll get some planes where that's all, there is no economy class. It's all
you and I are flying
seating,
to Miami. If anybody on the Carson team listening wants to get us a Concorde to take us to Miami, we'll take it, That's in March. Anyway, we'll just fly around. We'll just fly around.
The road for
we'll do this podcast on a Concorde. Wouldn't that be cool? I think it'd be cool.
That would be amazing. By the way, I must say, I was on, when I traveled to India last month, I was on Qatar Airways, and they had Starlink.
Mm-hmm.
And it was amazing. Like, I was FaceTiming my family from the plane. Yeah. First time I ever did that. It was probably better than this internet connection I have here at home.
Mine too.
But it was, that's the time we live in. Was that amazing? But anyway, you want to talk about the consumer?
I opened the door
for
the K-shaped economy. You've done some incredible work. You've updated these charts. I mean, they keep telling about the same thing. I know you want to share some charts as well. So we'll just let Connor know which ones you want, and he can mark them here. But let's dive into some of those cool charts on the YouTube channel coming up.
Yeah, so let's put this one up. Aggregate household balance sheets. It's got a whole bunch of colors there. It's got red and blue and green. Green is for stocks. There's brown as well for real estate. But the story is, look, aggregate household balance sheets, which means balance sheets when you take all U.S. American households together. That's in as good a shape as we've ever seen. Yes, you and I have been telling the story since 2023, which is why we were positive about the economy back in late 2022, early 2023. But it's gotten even better. Right now, net worth, household net worth, as a percent of disposable income is 770%. That's up from 740% at the end of last year. It's up from 680% at the end of 2019. Even back in 1999, when we think about, that was a good time for everyone, the stocks, going up. So yes, it was a bubble, but still, you compare it to that peak period. Right now, we are at 770%. Net worth is a percent of disposable income. In 1999, it was just under 600%. And you think, what's driving that? What is driving the 770%? So it's assets minus liabilities. Assets are 862% of disposable income, Ryan. Liabilities have been shrinking, right? Liabilities as a percent of disposable income is 92%. And Connor, we could put this chart up showing American households are much less levered than at any time over the last 2.5 decades, right? Back in 2019, end of 2019, liabilities were about 101% of disposable income. Since then, it's just been straight line down, 92%. When was it really bad? This was just before the housing bubble, which is why the housing bubble was as bad as it was, because people are so levered. And then, equities, home equity crashed, the stock market crashed, that became a problem. And at the end of 2007, liabilities as a percent of disposable income was 137%. We are at 92%. This is the lowest, as I said, we've seen in 2.5 decades, right? So I think that's a great story. And why have liabilities have gone down, but assets have also gone up. And two assets in particular, And this gets to
let me
the
just jump in just for a
economy,
second.
but yeah, go
You're
ahead.
talking about leverage,
Yep.
right? Too much leverage in the system. I used this quote before, but I always got a good chuckle. Charlie Munger said there are 3 ways a smart person can go broke: liquor, ladies, and leverage. So we've seen that. And I just want to hammer home again one thing you pointed out. What we hear all the time, right? You and I get to work with our amazing Carson partners all over the United States, get to see their clients the next couple of weeks. You and I are flying all around the country to, again, do some client events and do some things how we see it. And we just leave room for Q&A. And I just don't always dive into this during the conversation because I know the question is probably coming. What about all the debt that's out there? Yes, we have a lot of debt. 1.32 trillion in credit card debt, close enough for government work. In fact, it is government work that does it.
18 trillion total,
14 trillion mortgage, another couple trillion in school loans, all that stuff. That's a lot. That's the most ever, and it continues to go higher. And here's a spoiler alert: 10 years from now, it's going to be higher. 20 years from now, it's going to be higher. What you just said, though, is leverage or debt as a percent of disposable income, or liabilities as a percent of disposable income is actually a lot better than it's been the last several years, even with all the debt that we have added the last several years. Why is that? I like to keep it simple, because if you own a house, maybe a couple, if you own stocks the last couple of decades, how are you doing? You're probably you might have more debt out there, but you likely have a lot more equity. And that's, I think, what you've been saying, and something we've been saying on our team since 2023. Eventually this might change. We'll know, because Sonu, you follow the data very closely, but it hasn't changed yet. Anything you want to add to that or dive into the other stuff?
No, so there's no issue when you think about, okay, how could the cycle end? What is exactly as you said? Too much leverage.
Well, apparently, it's liquor and ladies also. So I don't think
liquor and ladies.
We don't have those problems.
But let's look at the asset side, which is actually interesting. Like, why have assets gone up to what it is 862% of disposable income? 2 things. One is real estate, right? Real estate prices, home prices, basically, as a percent of disposable income. Right now, it's about 210%. That's down. In 2022, it was actually higher. It was about 238, 240%. But, since then, home prices have cooled a little bit. And that matched the peak of the housing bubble. That was the absolute peak when you saw, home prices as a percent of disposable income. And Connor, we can put this chart up. Rising home price and stock prices boost households. So right now, we are at about 210% home prices, real estate values as a percent of disposable income. And the nice thing is that's coming without a lot of debt, unlike in 2007, right? That's a big difference, right? So that's a very good story there. The other thing is stocks, right? We know what stocks have done. Equities as a percent of disposable whole income is running at 290%. That is the highest ever, thanks to stock prices, right? At the end of 2019, it was 210%. We're at 290% right now. In 2007, it was 160%, right? Even at the height of the dot-com bubble, equity holdings as a percentage of disposable income was 190%. We're 100 percentage points higher than that right now, which is incredible.
Maybe you mentioned this, but I want to make sure we explain it to the listeners out there. You're doing this as a percentage of disposable income. We do that to make things more apples to apples. But why do you use disposable income versus, I don't know what else, anything else? Why disposable income? Why do you use that one?
Mostly because that's, when you think about debt, especially, or even, like how much income is coming from your assets, that's a flow, right? And then, so I compare that to disposable income, because disposable income should just, with inflation, nominal wages should go up over time. As there are more workers in the economy too, remember, this is disposable income across everyone in the, economy. As the population grows, we should see that go up as well. So it's a nice way to normalize it, because disposable income is also what is used to service debt. That's why I like using disposable income. Right. So, that's but one thing is, it's great that I think stocks are becoming, stocks have boosted net worth, assets as a percent of disposable income. But it does leave me wondering, I'm always thinking about, I'm a global macro strategist.
You're a VP, comma, global macro strategist.
Yes, thank
you. We just do jokes anymore, guys. Just to make ourselves laugh. Yeah. Don't know what that title means, but you're VP, comma. I don't know. Anyway, VP, comma. It's very
comma is important. But anyway, so I think what could upset the apple cart is a bear market. Not a really quick V-shaped, crash and recovery, because like what we saw Liberation Day or even 2020. I think a long drawn out bear market, like 2000, 2001, 2002, or 2008, 2009, because that can really drive net worth down, right? And this gets to like, okay, if there's some spending happening because people think, oh, you know what, I'm worth more. Yes, it's because of stocks, so what? But I'm worth more, so I can go out and spend more. That leaves you vulnerable to a long drawn out bear market. Now, that's not an outlook anytime soon, to be clear, but that's a risk, right? Because think about how the cycle could play out, right? We get rising unemployment. That means aggregate income falls, disposable income and all of that. We get lower spending. Remember, one person's spending is another person's revenue, or another business's revenue and profit. So you get lower profit growth. That could lead to a bear market, and a sustained bear market, potentially. And then because of that, now, since household balance sheets are propped up by stocks, if you have a sustained bear market, household balance sheets start to shrink. Then you get even lower spending, even lower revenues, lower hiring, and then you're back to that same situation. We could get into this negative feedback loop, right? I don't think this is going to happen anytime soon, if ever. But, this is something, if somebody asks me, like, what's the risk here? That's the risk.
Well, I mean, you think to the great financial crisis, obviously people's equity portfolios were cut in half, maybe even more in some cases. Your home value was down. If you owned a lot of real estate in places like Florida and some of the boom places, well, those houses were just, those values were down. So yeah, that hurt consumption for a very long time. And honestly, it hurt overall psyche of a lot of people. I mean, when we get to travel the country again, I talk to people and they never come up and ask me this. Usually it's after the fact. You're kind of say, come over, because they kind of want to mention it to a room full of 100 people and say, hey, bottom of the financial crisis, I sold everything. Bottom of the 100-year pandemic, March 2020, I sold everything. Oh, I heard that Trump was going to wreck everything last April, so I sold everything. What do I do now? I don't have the answer. I mean, I try to give a nice answer, but it's like, don't listen to your financial advisor next time, and don't sell everything when it looks bad out there. I don't have the exact answer, but we see that time and time again, and that psyche can obviously impact a lot. What else? Yeah.
Actually, on that, I want to seg off of that, because you go speak to, I know you do once a year, maybe twice a year, you go back to your alma mater.
Yeah.
I think it's Xavier, right? And you speak to the kids there, which is fantastic. I don't quite do that, which is awesome. And like our founder, Omani, basically, after the last podcast, he sent us, a nice message. We were just talking about college, right? Your daughter is going to college next year. This year. Fingers crossed.
Yeah, and 6 months from now, give or take. So 8 months.
6 months from yeah. And I'm wondering, like, like the value of college, and and when people used to ask me, like up until let's say 4, 5, 6, 7 years ago, so I have my son's graduating. What do you recommend he does? Should he do STEM, like math or science or engineering? Obviously, that I'm a brown Indian guy. People ask me about engineering for obvious reasons, and I'm an engineer too. And back then, I was a little more comfortable about do data science, things like that. And now with AI, I don't know. I'm curious. Like, what do you tell people? Like, I'm sure you get the question. What should I do?
Yes, that is a popular question, and you just mentioned AI. I mean, the stuff that we've been doing, you've been doing, I've been doing. It's we weren't doing that a year ago, and it is what's the Jensen quote? I'm going to butcher it, but they asked Jensen late last year, is AI going to take everyone's jobs? He said no. AI is not going to take everyone's job, but the person who leverages and uses AI is going to take your job. And that always stood out to me. I thought that was a really interesting way to look at it. And again, the stuff that we're doing, we are as productive as we've ever been. I mean, the stuff you and I are doing, the stuff you did over the weekend to get some data for us. It's like, wow, we couldn't have done that a year ago. And because of AI, we're pulling data and getting things that we've only dreamed of having, and now we're able to do it. So I think it's the realization that you still need to find something that you're passionate about. You still need to find something that you love to do.
Yeah.
But the world is changing quickly. I mean, just like the internet, a lot of people did, quote unquote, lose their jobs after the internet, but now people literally, bring you food because you push a couple buttons on your phone. I mean, you don't know how it's going to go, but it is a quickly changing world. And someone whose daughter looking at schools and getting yay or nay or how much money they're all going to give. And you're looking at this stuff literally like there's a couple schools she's still interested in. We haven't heard from yet. We'll hear from them soon, trying to determine.
Okay.
Yeah, well, we'll see. Trying to determine what to do and what's the right thing. Nobody really knows. But I do enjoy usually, I guess, September, October-ish, I get to go back to Xavier and talk to an MBA bond class of students. And it is a lot of fun. And
hey, did you say
it's
a bond class?
I don't fit in at all, but no, they get it. It's just a bond class, but there's some equity people in there too. So it's unique. But you mentioned AI, and one other thing, I know you listened to Matt Damon and Ben Affleck on who was it? It was with Rogan.
Yeah.
Rogan. And you shared a thing with the team, and I didn't look at it yet. But Ben's take on AI, you want to talk about that? Do you think it was interesting? Is it worth discussing on this podcast? You think?
Yeah, dude, he said exactly the same thing you just said. Okay. The people who will be successful at this stuff will use AI as a tool. He doesn't think AI is going to write a great new movie or something, because AI tends to, and you all can go listen to it. It's great. He's such a smart dude. I mean, and which is interesting because his line of work you would think would be susceptible to AI, writing scripts, creating visual effects, all of that stuff, right? Like the movie business would be, I imagine, really susceptible to AI coming in, just replacing a whole bunch of people. But he was like, for creativity, AI, if you ask AI to do something, it reverts to the average because it's basing everything on what's come before without getting into regression and multi-regression analysis and things like that. It's actually, that's what it's doing. It's looking at what happened in the past, its database of its training set, and say, okay, this pattern or this set of instructions or this set of information happened here. So I know what the future relative to that is going to be. So now I'm going to, that's my answer to the query I put in, to the prompt, right? That's not how creativity works. Yeah. Creativity doesn't work. Even just think about, forget Ben Affleck and Pat David.
I can't. It's hard to forget about those two.
Yeah. When you make a chart, there's some creativity. How do I put this information in the best possible way? Even little things like, should I put an extra column here? Should I add this data? You'd be like, maybe not. Maybe that's too much information, right? But there's some creativity that goes in. Same thing when I make my charts about household debt, what should go in there, right? And that comes from, I think, experience too. But that's a creative process. I mean, at the risk of, sounding like, hey, I know the limit. I think hopefully I know the limits of my creativity, but I'd like to think I'm creative enough.
I think you are. I mean, that's one thing about what we do, what I do, what you do that I really, let's talk about me for a second. Let's talk about me. No, but what I love about this job is we get to talk, I get to work with you, but some days, I fly around the country and it's busy and you're talking and there's a lot going on, a lot of just stuff, you're always on. I call it on time. So I'm always on. There's 100 people looking at me here, 100 people looking at me there, whatever. It is what it is, my job. But I love that stuff. But then, some days I'll look at my calendar and there's not a lot on my calendar. So I know I'm going to spend 4 hours just going through email because that's usually what happens when you travel, you're way behind. But I love to just get into some data, give me some Excel data, read what you're saying, read what other people are saying, people I respect and love and listen to. And my brain just starts thinking of cool charts. I love, obviously made a career on this, creating tables, creating charts to tell a story. And I just love some little downtime, put a little music on, just kind of get in my little zone and create and be creative. And what you just said, what Matt Damon said is true. And I will point this out too.
And you need curiosity.
You have to love getting in that data because it doesn't always come out right. In fact, it rarely comes out right the first time. And you're like, what did I just do?
If you think of data or tables and charts, those are answers. But you need to come up with
what did Dr. Seuss say? The answers are easy. The questions are hard. I mean, there you go. But the little promo or I don't know, promo, whatever. Ben Affleck, he had a movie called The Way Back. It was a basketball movie. It came out in 2020. It was lost in the shuffle. All right. It was just lost. Well, nobody did.
Oh, I didn't see that.
That's the thing. Nobody saw it. That's my point. So it came out during COVID, whatever. It probably was coming out in March or April of 2020. And it was really good. I had to look it up. I forgot what the name was. I just typed in Ben Affleck basketball movie. But that's a little recommendation from Ryan. The Way Back. He's he's an all-star, all-state basketball player. Hit rough times. Gets a second chance with his high school. Becomes a coach. Of course, there's some ups and downs there. But really a cool movie. And yeah, it's about basketball, so I like that. But it's a lot more than that. And that was one that I think is lost in the shuffle of COVID, like a lot of good things. Check out The Way Back. All right, so we're going all over the place. What time is it? We'll probably wrap it up in 10 minutes. What else do we want to talk about? Fiscal policy as a tailwind? I know we've done some stuff. Or what do you think? What do you want to do?
Sure. I don't know if I want to talk about fiscal. No, we can talk about fiscal policy. Yeah. I mean, so we've got a lot of fiscal policy. We got like on the negative side, we can talk about tax. But on the positive side, I mean, yes, I think there's a lot of essentially the idea is the Trump administration wants to make things cheaper. Whether it's trying to make gasoline prices cheaper by getting oil from Venezuela. I'm not saying any of this will work or Congress will pass it, set that aside. This is what they want. This is the intention. They want to make home affordability, be in a better place. And that's why they're trying to buy $200 billion of mortgage-backed securities, banning large institutional companies from buying homes so that home prices, there's less upward pressure on home prices because of institutional players. Whether that will happen or not is a whole other thing. Again, go read the piece today that I put up, carsongroup.com/research. I talk about a bunch of stuff. Same thing with credit card interest rates. Yes, you put a 10% cap. Sounds great. Oh, yeah, that's fantastic. I don't have to pay more than 10%. Well, if you are somebody who was paying 25% interest rates because you were carrying over a balance, my guess is the credit card company will probably just cancel your card if they can't charge you more. Right? That is likely to happen. The availability of credit goes down. That's all on some of that, I think it's called a well-intentioned policy to, improve affordability that could go the other way. But we do have a couple of big tailwinds. One is tax cuts. Last year, we actually talked about this in our 2025 outlook. It was less so about 2026. But Congress passed the bill just the way this thing goes. By the time it was passed, it was like summer. But all the impact is coming right now. And two big impacts. One is because of tax brackets and things like that, tax withholdings from your paycheck go down, which means take-home pay increases.
Now, Greg Ip wrote a great article about that one over at the Wall Street Journal.
Yes, exactly. And then because a lot of the tax cuts are retroactive to 2025, people will start seeing excess refunds, right? A lot of households get refunds every year. I don't think that usually boosts spending one way or the other. It's baked in, right? I'm going to get how many ever thousands of dollars or hundreds of dollars, and a tax refund that's baked in. But this time when they file their taxes, if you get an excess refund, that's almost like a stimulus check compared to like what happened in 2020, you get the CARES Act, 2021. What do people do with that stuff? Most of it went down to paying debt, but maybe about half of it or so, maybe 40%. But a big chunk of it went to boost spending. Now, of course, there's a reason why, going back to household balance sheets and debt, why debt is low, because they use the stimulus checks to pay down debt. Right now, households are in a good place where they may not need to pay down debt because they don't have too much of it. And so I think this boosts consumption. At the margin, it could boost even stock price.
Interesting.
Right? Like if people say, you know what, I'm going to take a flyer here and buy some stock because I got an extra $1,000 or $2,000, whatever it is. So that tailwind is there. And then the other, there's always Fed rate cuts. We could talk about the whole drama.
Let me jump in. Let me jump in.
The Fed chair. That's
friends over at Wells Fargo. They said the average, again, no such thing as average. We like to point that out. But the average tax refund might be up 18% year over year. So again, if you made $3,000, well, add 18% to that. If you got back $3,000, add 18% to that. Well, you're talking some real money. You're like, oh, that's not too bad. Shout out to a friend, Josh Schaefer over at Barron's, who did some stuff on that. And you cited Josh and Greg in a really, really good blog on Friday, I believe. But go to carsongroup.com/research. You can find that. So again, that's fiscal policy. Monetary policies, the Fed, we have AI spending. We talked about all of these concepts in our 2026 outlook called Riding the Wave. You can find that recent podcast, by the way. Subscribe.
There's a new name in the mix, by the way, for the Fed chair. There's a new name in the mix. It's Rick Reeder.
He was in, then he was out. Okay.
I guess he's in again. I don't know. This morning, maybe the odds have changed, but apparently... Kevin Hassett was in the lead.
Trump said, stay where you are. Not anymore. By the way, speaking of stay where you are, there's two teams in the NFL that have the same coach as 5 years ago. The Bengals and the Chiefs. Everybody else fired their coaches. Literally, there are teams, Sony, they're like a play or two away from like Super Bowls and stuff. They're firing their coaches. As a Bengal fan, we are stuck with the same, I can't cuss on my podcast, but I want to, coach who's terrible. Like, please, somebody out there, help the Cincinnati Bengal fans and fire our coach like everybody else is fired. They're good coaches. Anyway, just one enough about that.
Speaking of football, congrats to the Hoosiers. I know they're like rivals. I went to Purdue, but hey, Indiana and all that. And good for the Big Ten.
I've been poking the bear with SEC fans.
Well, I know.
I lived in South Carolina for a while. I loved it. Loved Charlotte. But SEC country, Clemson country, it's all I heard. So it's just nice, in my opinion.
Yeah, a little chip on their shoulder, I feel. I mean, I don't know. It's not like I watch a lot of football, I think, to be clear. But if I do watch football, it's more college than NFL.
College has turned into NFL, as everybody's complaining about. But nonetheless, congrats to the Big Ten. Congrats to the Hoosiers. I mean, they are, they being the Hoosiers, have the second most losses in the history of college football. 700 and something. I forget the exact number. I mean, they literally had like the most. I mean, they're like most Hoosier fans would probably agree, they were always the doormat of the Big Ten. And in the history of anything, at least in terms of sports, I don't know if there's ever been a turnaround like this. I mean, I don't. If there has, let us know. But people were talking about that last night. Like, to go 16-0 and beat everybody in front of you and playing in the best conference and beating everyone in the best conference and then going and doing it again. It's and shout out to Miami. They valiant effort. That game could have gone either way, but I do think the better team eventually won, and congrats there. I had something else I wanted to say. Let's see. The bank.
It's not the African Cup of nations, the football championship in Africa. No, but that final was a little crazy too. So I won't talk about it. You go Google it or something, you'll see it. It was insane. It was
what's not nuts, but a little interesting. The Global Fund Manager Survey over at Bank of America. We talk about this a lot. Just came out like today, I think. The recent data, the most bullish that active managers have been since July of 21. The lowest cash allocation ever, and those expecting those invested overweight equities, the highest since December 24, and those expecting a better economy, 38%. That's the highest since July of 2021. So, long-winded way of saying people are noticing, Sonu, that things are pretty good. Of course, 3 years ago when you and I said things weren't as bad as they told us, everyone laughed at us and mocked us. But now I'm looking around, noticing some agreement. Not saying it's the end, but I will say that that's just something that, my little spidey senses radar is like, ooh, I don't know. And then I know like the AAII, we get it. There's flaws with it. But most bulls we've seen there in a while, put to call ratios are fairly low. So I'm not saying we're due for a big upset, the apple cart moment, but there are some things out there that are taking place that, are part of a bull market. I mean, I don't know who said it, but I've heard it many times. You're allowed to have bulls in a bull market. I mean, bull markets are supposed to feel fun. There's supposed to be a point where they feel pretty good. And then
I feel like I should write that down. That's one of those things that is a good reminder.
I mean, late 90s, different times, people feel good. You're making money. You're allowed to feel that for a while. Then there's a point. And I will say, from a sentiment point of view, just some of that, we mentioned it maybe a month or so ago, the big IPOs expected this year. I mean, SpaceX is one, and there's some other really big ones. There's part of me that thinks, oh my goodness, big IPOs means it has to end. I'm not saying that, but you can go back and cherry pick some big IPOs or some big managers at marked times, but I don't think we're there. But it's just part of it. You're allowed to be excited. You're allowed to feel good about things. And I just don't see that yet. Maybe 2026, we're going to start to feel a little bit more of that. And I think that's a good thing. But, just some interesting concepts. But again, the Bank of America Global Fund Manager Survey is showing some optimism for the first time in a very long time.
Do you think most of those fund managers are on the AI side of things, and now they're getting caught a bit flat-footed because everything else is rallying? I don't know if you have the data in front of you.
I don't have it in front of me, but I think so. And these are the same managers in April were the ones on TV telling you to get out, telling you how bad it's going to be. So listen, just take it with a grain of salt. But that got me. So I mean, we could go all day. We need to wrap it up. What else you want to talk about? I mean, there's some drama with the Fed on Wednesday. What else? Anything else you want to hit on here? I don't know.
Yeah, there's all. We're at in the apprentice stage of the Fed chair, and knowing the president, he's going to milk it for as much as that is worth. Yeah, not that he needs ratings or anything, but I think he wants it. But I think going back to what we started, the show with, I think it's about when do we get tacos, right? How much pressure can the administration take if the market pushes back, especially bond yields? The stock market, I think they can write it off as, stocks are always volatile. It's still near record highs, obviously. Look at it, right? But bond yields going up, that hits affordability. All these things are doing on the affordability front. Mortgage rates, all of that. If the 10-year yield goes up, that's not good for any of this. In fact, it may not even be good for stocks. If the 10-year yield goes above 425, 430, again, you go to Josh Schaefer. He had a nice chart. I wish I could put it on. I'll try and send it to you, Connor. He had a nice chart showing that over the last 3 years, whenever the 10-year yield has gone above 425, and when it's rising, equities take a hit. So something to keep an eye on.
Definitely something to keep an eye on. Let's see. So next week, it'll just be regular podcast, right? Also, we're doing a live stream. We probably should start promoting this. We need to really get our act together on this. We're doing a live stream on the 30th, which is 2 Fridays from now. The plan is to do it an hour before the close, so call it 3 o'clock Eastern, 2 o'clock Central Time. We have a pretty big name guest. Maybe we don't mention that yet, but we wanted to do more live streams with this very podcast and potentially have more guests and more like a happy hour theme. We've kicked around some names. I'm not sure if we've landed on it yet, but more of a laid back, just fun market wrap up conversation. So
come and join us on your Friday afternoon. The markets are at close. Hopefully you're taking it easy. Maybe it's pre-happy hour, but feel free to just join us on YouTube.
And hopefully we'll get some links to that so people can sign up for it ahead of time so they know that it is coming. But I guess if you follow us on YouTube, if you subscribed on YouTube, I'm pretty sure when it goes live, it'll give you a warning, or maybe you need to ask for the warning. We'll figure all that out.
Maybe.
But just kind of pencil that in for 2 Fridays. We'll have a special live stream with a pretty big guest. We need to cross some T's and dot some I's behind the scenes on that to make sure it goes off without a hitch. All right, everyone. Well, this was fun, Sonu. Great to chat as always. There's tons of things going on out there. It's still a bull market. Economy still strong. Volatility is the price we pay to invest. We talk about that a lot. The uncertainty over all the geopolitical stuff is swirling, but I think there's still more positives, negatives is how we would kind of sum this whole thing up. So everybody, again, this was episode what, Sonu? 171? 171.
Yep.
When do we get tacos? Now, all this talk, I think I'm going to have to get a taco for lunch. I don't know. It might be time to do that. Not breakfast, but lunch. So anyway, all right, everybody, stay warm. We'll see you next week. Take care. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.